Is that $5,000 withdrawal request actually going to hit your bank account, or is it about to get denied because you broke a rule you didn't even know existed? Because missing the fine print kills more payouts than bad trading ever will. So I'm Robert, and I'm a funded trader, and I've been around long enough to see all kinds of payout denials from almost every prop firm. So I know exactly where the landmines are. Most traders spend 99% of their energy trying to pass the evaluation. They worry about the profit target, the trailing drawdown, but they spend 0% of their time reading the contract they sign once they get funded. So here's the reality, guys, and you know this already. Prop firms, they're a business, and they're not charities. And while the good ones want you to succeed, there are plenty of rules buried in the terms and conditions designed to protect them and not you. So today, we're going to break down 5 specific hidden clauses that void payouts. We are not talking about hitting your max drawdown. Everyone knows that. We're talking about the rules where your balance is green and they still refuse to pay you. So if you don't structure your trading around these 5 rules, you're essentially trading for free. Stick around for all 5. Number 4 is the one that catches most people recently, and sometimes regardless of whether they actually broke the rule or not. So if you're trading with a prop firm right now, hit subscribe so you don't miss the next breakdown, and let's get into it. The first rule, and the one that catches the most people off guard, is the profit consistency rule. And if you've ever had a great trading day that made your whole month, you need to pay close attention, all right? You might think that the profit target is $3,000 like on a 50K account. Let's say you make $3,000 and then you get paid. And that's not always true. Many firms have a clause stating that no single trading day or even a single trade can account for more than 30, 40, or 50% of your total profit withdrawal. It can be even lower on instant funded. It can be as low as 20%. And so let's say that you have a slow month. Let's say you're grinding, you're breaking even, whatever, CPI hits, and you catch a massive runner on NQ. And you make let's just say you went crazy. You make $8,000 in a day. And you're ecstatic. You hit your withdrawal threshold. So you go, you jump on the website, and you request the payout. Denied. Why? Because that one day constitutes 80% of your total profit. The firm looks at this and says, this is not a consistent trader. This is a gambler who got lucky. And to get that money out, you now have to go back into the market and trade additional days to dilute the percentage down. And we all know what happens when you're forced to trade just to satisfy like a math metric or something. You're going to give the profits back. So check if your firm has a 30% rule or a consistency rule before you take the massive swing. Check before you start trading. If they do, you can't rely on one big day to get paid. You can't. Now, there are firms that have these, and we'll talk about that later. Now, that one's frustrating enough, but the next clause is even worse, especially if you're a scalper, okay? So number 2 is the minimum trade duration rule. If you're a tick scalper or you trade heavily on the DOM, this one can wipe out entire day's profits without warning. Some contracts have a hard-coded rule that a trade must be open for a minimum amount of time, usually 10 seconds, 1 minute, sometimes longer, whatever the different firm is. But to count, it has to be held for long enough in order for it to count as a valid profit. So let's say you short the ES. It flushes immediately. You cover for a quick 4-point game. Boom. The whole thing took 6 seconds. Great execution. But when you review the account, that profit might be removed, or worse, uses grounds to terminate the account for tick scalping, micro scalping, unrealistic execution. Firms put this in because they cannot replicate sub-second trades on the live markets due to latency. So if you're scalping for 5 or 10 seconds, you're walking on thin ice. Verify exactly what their definition of a valid trade is. Do not assume that because the platform let you close the trade, the firm accepts it. Now, if short trade duration can void your profits, wait until you hear what happens with your fills during news events. Quick question before we keep going. Drop a comment below. Which of these clauses have you personally run into? I read every comment. Your experience might save another trader from making this same mistake. And if you're getting value from this, hit the like button. It genuinely helps more traders find this video. All right, so let's keep moving. This leads us directly into number 3, the news trading clause. And this one is not just don't trade news. It's far more subtle than that. And we all know some firms that ban trading, 2 minutes before and after a red folder event, and that's standard. Red folder event comes from Forex Factory. These are high impact events on the market. The hidden clause is a volatility and slippage disclaimer. Even firms that claim to allow news trading sometimes have a clause that they reserve the right to trade fills or void profits if the execution price does not match real market liquidity. So, for example, let's say you play non-farm payrolls, right? You have a buy stop order and the market just rips to the upside. You get filled, you make a massive profit. But in the real market, there was no liquidity at your entry price, meaning there was no actual order sitting on the ladder at that price. There was no one there. You got filled on a demo environment feed that did not reflect the actual slippage or what your real fill would have been. The firm reviews that trade, cites abnormal market conditions, and then it deletes the profit. And they're not technically banning news trading, they're banning unrealistic fills. And since you are trading on a simulated feed for most evaluations and some performance accounts, every fill during news is technically unrealistic. And if you want to secure the payout, avoid the immediate whipsaw of the release. Let the market settle down. Do not give them an excuse to look at your logs. Let the market settle down first so that you can get a real fill that would be at a level that makes sense. Now, all of those clauses protect the firms from market risk. But the next one, number 4, is designed to catch people who try to game the system. And this is the one that I warned you about at the start. Number 4 involves specific strategy bands, hedging, group trading, and certain types of algorithms. This is where people are trying to game the system, they get caught, and sometimes innocent traders get swept up in this too. So there are clauses that strictly prohibit grid trading. There's clauses that strictly prohibit martingale systems. The martingale is where you double down on your position size every time you lose, hoping that one win will cover all the losses. Prop firms just, they hate this. It's a guaranteed way to blow your account eventually. Given enough time, it will eventually blow up. If their algorithm detects that pattern, they'll flag your account for gambling behavior and void your contract. Also, be very careful with trade copiers. If you and a friend are taking the exact same trades at the exact same time, or if you use a signal service that 500 other traders are using, you trigger the group hedging flag. Firms have risk management software that scans across their traders. If they see 100 accounts enter the exact same trade at the exact same millisecond, they assume it's a coordinated attack and that one person is managing multiple accounts illegally. They'll ban everybody involved. So keep your strategy unique to you. Stay away from doubling down grid systems. One more, and this last one quietly destroys more funded accounts than anything else on this list. If you don't understand how this drawdown rule works, it will end your account on a profitable day. So guys, listen, if you want to compare all these rules easily, just look into the description for my prop firm comparison list, where you're going to be able to see all the different rules along with the best discounts available in most firms. Finally, number 5, the intraday trailing drawdown. And this is the one that quietly destroys more funded accounts than any other rule on this list, because most traders do not understand how it actually works. You start the day at $50,000. You take a great trade and your equity runs up to $52,000. You feel amazing. But now your trailing drawdown floor has silently moved from $47,500 to $49,500. You give back some of the profit. Your balance drops to $49,400, but you just breached the trailing drawdown and your account is terminated. You made $2,000, gave back $2,600, and you were done. Not because you had a losing day, but because the floor moved up with you and you didn't realize it. The hidden part of this clause is the word intraday. Some firms trail your drawdown in real time, tick by tick. That means that if your equity spikes, even for a moment during the volatile candle, your floor moves up with it permanently. You might not even notice it happen so quickly. And what you need to know, whether your firm uses a static drawdown, an end of day drawdown, an intraday trailing drawdown, they're completely different risk environments. And if yours is intraday trailing, you need to manage your open profit just as carefully as you manage your losses. You have to take base hits and get in and out quickly, because in this system, giving back the open games is the same as taking a loss. Here's the bottom line. The 5 clauses are the ones that catch funded traders off guard. These 5 rules catch traders all the time. Number 1, the consistency rule, where one big day voids your payout. Number 2, the minimum duration rule, where the fast scalps do not count. Number 3, the news slippage clause, where unrealistic fills get deleted. Number 4, the prohibited strategy ban, where copiers and martingales get you flagged. And number 5, the intraday trailing drawdown, where giving back open profit terminates your account. So the prop firm model works if you treat it like a professional partnership. But if you treat it like a video game where you're going in trying to exploit a glitch, or you're going to run into these walls. These clauses, consistency, minimum duration, news slippage, prohibited strategies, and the intraday trailing drawdown, are the filter. They filter out gamblers from traders. Read the facts, read the terms of service, because knowing these rules is what gets you paid. And if you want to know which of these firms actually have fair rules and which ones are looking for a way to deny you, check the links in the description below. I keep an updated list of the firms I personally trust and trade with. And if this video saved you from a hidden clause, please hit subscribe, turn on the notifications, because next week I'm breaking down Take Profit Trader, and you don't want to miss that one. Don't let a hidden rule take your profit. Trade smart, and I will see you in the next one.